Chapter 20, Risk Management and the Financial Manager. Introduction. Chapter 20 discusses the importance of risk management for financial managers and explores various risk management strategies. It emphasizes the impact of price volatility on companies and the need for effective risk management to ensure stability and profitability. The chapter introduces the concept of hedging as a tool for managing risk and explores specific types of risks that firms commonly face, such as commodity price risk and exchange rate risk. Learning objectives. By the end of this chapter, you should be able to 1. Describe commodity price risk and explain different hedging strategies. 2. Understand the concept of exchange rate risk and identify different types of risks associated with it. 3. Explain the use of forward contracts and option contracts as hedging tools. 4. Analyze real-world examples of risk management strategies used by companies. Key points. Companies face risks related to price volatility in their normal business operations, which can significantly impact profitability. Financial managers focus on increasing cash flow, managing the timing of cash flows, and reducing risk. Hedging is a risk management tool that involves taking offsetting positions to reduce the impact of price fluctuations. Long-term contracts, vertical integration, and futures contracts are commonly used hedging strategies for managing commodity price risk. Exchange rate risk arises when companies operate in the global marketplace and have cash flows in multiple currencies. Transaction risk, translation risk, and economic risk are different types of risks associated with exchange rate fluctuations. Natural hedges, forward contracts, and option contracts are used to manage exchange rate risk. Real-world application. One real-world application of risk management discussed in this chapter is the use of long-term contracts by companies to hedge commodity price risk. For example, Starbucks, a coffee retailer, could enter into an agreement with a coffee farmer to purchase a specific quantity of coffee beans at a predetermined price over the next several years. This allows Starbucks to lock in a price for its raw materials and reduce uncertainty about future costs. By understanding and implementing risk management strategies like this, financial managers can protect their companies from potential losses and ensure stable cash flows. Conclusion. Chapter 20 highlights the importance of risk management for financial managers and provides insights into various risk management strategies. It emphasizes the role of risk in financial decisions and the need for effective risk management to ensure the stability and profitability of companies. By understanding and applying the concepts discussed in this chapter, you will be equipped with the knowledge and tools to effectively manage risks in the financial realm.